The price-to-earnings ratio is a fundamental tool investors use to gauge if a stock price makes sense relative to its actual profits. Often called the PE, this simple calculation helps you understand what the market is willing to pay for every dollar a company earns. To find the ratio, you divide the current stock price by the company's annual earnings per share. A high ratio suggests investors expect strong future growth, while a low ratio might mean a company is overlooked or facing challenges. While PE focuses on profit, the price-to-sales ratio looks at total revenue, which is helpful for companies that are not yet profitable. Different industries have different norms. A tech company might naturally have a higher PE than a utility company due to growth expectations. Remember that a single number does not tell the whole story. Always consider the broader financial health of the business before drawing conclusions. The PE ratio is just one piece of the puzzle. Subscribe for more basics on how to analyze stocks. Educational content, not financial advice.